Hello students, as we discussed in class, we need to know the calculation process of the free cash flows in order to measure the value of the project. So the free cash flows in a project year is just the sum of the cash flows from the capital investment, for the usually initial investment today, and then the last year the sales on an assets, and then we also subtract some taxes. And then the cash flows from operations, only the incremental changes from that from that project generating the revenue and the cost and some tax, and then add back depreciation. We also need to consider the net operating working capital, which is the current asset minus current liability. If the project increases the working capital between 2 years, then this is the cash out, right? Because they spend more inventory, they have more accounts receivable, but they have the smaller amount of the current liability, which is accrual basis. Okay, then let's go to this very basic but very useful practice. We have input variables. Initial investment $10,000. That initial investment is a project. By investing $10,000, we're gonna make some profit, right? Future cash flows. The useful life of the invested asset is 5 years, and then service value 2,000. We assume that we will sell this asset at the end of year 5 at $3,000, which is higher than this service value. Okay, and then the selling price, that is the elements of the revenue sales. Selling price per unit is $15, and then the number of sold a year is 1,000. But we will assume that we are going to assume that the number of units sold a year, or the selling price, the sum of this, or multiple of $15 per unit times 1,000 is going to be growing with this 5% growth rate. Then we need to measure the variable cost and the fixed cost here based on the percentage of sales. The fixed cost is just fixed cost, not aligned with this sales, but will grow with the inflation rate, 3%. Discount rate is the rate that discounts the free cash flow, future cash flows made by this project to get the discounted payback period, or net present value, or the PI. Then accounts receivable and inventory, those information is the current asset, right? Current asset part, which is the operating working capital. That is not the cash, but we measure the cash amount from the revenue and expenses. And we don't have any other current liability here, so we don't have to consider. So the current asset, which is accounts receivable as fraction of sales at the current year, 70%, and the inventory following expenses, assuming inventory, direct material, direct labor, or work in process, or the next year. So we assume that that inventory made is going to be the sold next year. So we put this 15% for the inventory, the next year. And then the tax rate is 35%. Okay. So let's go from this capital investment first. Capital investment. How to get this capital investment? Now, the investment in the fixed asset is $10,000, right? So we put this $10,000. Don't put the hard number here. Instead, we have to put like equal, and then we link from this input. By doing so, when we change this, the initial investment is automatically changed in this model. Okay, so please don't put the hard number there in your projection. That is the minus point of the project. And then the next year, we don't have any other information. Later, the investment in the fixed asset. And then sales of the fixed asset, we have that information, right? How much was that? We also don't put $30,000, direct number. Instead, we link from this input $30,000 sales of the fixed asset, $10,000, right? Then tax of gain on sales. Okay, then how do you get it? How do you get it? So we assume this $2,000 is the salvage value, right? So let's calculate it. 3,000 minus 2,000 is going to be gain from the sale, right? 3,000 is the sales price of this the invested fixed asset minus $2,000, which is the salvage value or the book value of, at the end of year 5. And then 35%. Where is 35% of the tax rate? So 350 is going to be tax amount, which is cash out. That's why I put here minus or plus or minus there. So based on this, minus 10,000 and then plus the sales of fixed asset today, and then minus tax. Then I'm going to be dragged to the right side. So we got the cash flows from this fixed asset. Okay. And then let's create this operating cash flows. The operating cash flows today, we don't have any sales revenue, right? And then the revenues, how to get it? Okay, the 15,000 was the selling price times $1,000. Then it's going to be growing with the growth rate 5%. So I'm gonna fix this growth rate so that when I drag to the right to the year 5, now it is increasing. And then the variable cost first year, there's no any number here. Then the fixed the variable cost. The variable cost is the 15,000 the sales times, what is it? Okay, 40%, right? 40%. So I'm gonna put this 40% fixed. So 6,000 is the variable cost that is going to be increasing along with the revenue, but the same percentage of the sales. Got it? So we got it. And then the fixed cost the first year was $4,000, right? But it is going to be growing with the inflation rate 3%. So let's just fix this so that when I drag to the year 5, it's automatically increased along with this the 3% inflation rate. Then depreciation. How do we measure the depreciation? The investment. Now the investment of this fixed asset was $10,000. What is the residual value based on the stat line method? Where is that? Okay, $2,000. There we go, right? Then divided by year 5. Okay, so got it. And then $16,000. $16,000 is the I'm gonna just put this number with the dollar sign, all dollar sign, so that we can fix this. Then let's just drag. So based on the stat line, oh, I didn't mention the stat line, useful life, the service value. Let me just put here useful life of the, and then depreciation. We don't have annual depreciation. Oh, there you go, the stat line method I posted. Then let's calculate the profit before tax, the earning before interest and tax. Here plus and minus, we put all the minus fixed cost and then depreciation, and then let's drag to the right side. Then we got this EBIT. then minus tax. How do you calculate tax? Times tax rate 35%. So I'm gonna fix this cell 35% tax, and then let's drag to the right. And then we calculate tax amount, and then add back depreciation. The same amount as we measured 16,000. So we add back, and then let's calculate operating cash flows. The operating cash flows is the EBIT plus minus tax and plus add back depreciation. So we got the operating cash flows like this. Okay, I'm gonna just use this. Okay, so we got the operating cash flows, as you can see this. So these operating cash flows is from all the possible revenue and the cost, including if there is an opportunity cost, we have to include that the effect on this the operating cash flows, or cannibalization or synergy effect, if we can calculate. Okay, and then